We just finished going through Vertiv's fiscal 2026 second quarter earnings call materials, and now we want to share our takeaways with everyone. Free cash flow up 234%, 234%, conversion above 150%, and the balance sheet flipped to net cash. On paper, this is close to a perfect quarter, and the guidance for the full year got raised on every single line. But don't celebrate yet, because 6 of the 17 questions on that call were about one delay, and management refused to put a dollar figure on it twice. That gap between the numbers and the silence is what I've been chewing on all night. The deck titles itself before it argues anything, and the title is doing real work here. Perfect grades, execution controversy, decoding the AI infrastructure boom, the 800-volt direct current transition, and the schedule shift delay. 3 subjects, and notice the order. The boom is the context, the voltage transition is the opportunity, and the delay is the thing everybody actually wants explained. A company that leads a deck with the word controversy is not hiding from it, and I'd rather see that than a title full of adjectives. The illustration walks you through a single AI rack, the power distribution unit, the 800-volt distribution, the liquid cooling module, and the thermal management system. A reasonable read is that management wants you to picture the physical box first, because their whole argument is that they own everything around the chip. Our take is that this framing tells you where to focus, 3 questions, and only one of them is genuinely unresolved. Hold that thought, because by the last page you'll see the company itself agrees with exactly that assessment. Let's put the two halves of this quarter side by side, because that's how the deck presents it and it's the right way. Earnings per share came in at 1.52, up 6%, beating by 0.12. Operating margin hit 22.6%, an expansion of 410 basis points, beating guidance by 140 basis points. And free cash flow of 925 million, up 234%, with conversion above 150%. Full year guidance was upgraded on all metrics, and the company reached a net cash position at negative 0.1 times leverage. Now the shadow on the other side of the page. Out of 17 analyst questions during the call, 6 focused directly on the delay, and management flatly refused to quantify the dollar amount of that delay twice. Here's my honest read: a quarter this clean shouldn't have a hole in it, and when a company gives you every number except one, that one number is the whole conversation. Let me explain the business, because it's simpler than the acronyms make it look. Electricity comes off the grid and has to travel a chain before it reaches a chip. The company's power chain runs switchgear into the uninterruptible power supply they call Tri-Energy, then into battery storage under the Energy Core name. Then the thermal chain heat rejection through the trim cooler and liquid cooling through the cool chip distribution unit. Because all that power turns into heat that has to go somewhere. And then, at the end, the server itself, which the deck is careful to note comes from NVIDIA and the silicon makers, not from Vertiv. The quote on the page is the thesis in one line: AI cabinets consume exponential power compared to traditional racks, and getting power in and heat out is the ultimate engineering bottleneck of the AI era. It finishes with, Vertiv does not make the chips, but the chips cannot turn on without them. Our take is that's the most accurate one-sentence description of this business you'll find, and it's why the demand side of this story was never really in doubt. Here's a strategy page that genuinely changed how I think about this company, so stay with me. The industry is moving toward 800-volt direct current power, but nobody agrees on how to get there, and the deck presents 3 paths. Path 1 is traditional alternating current infrastructure, widely deployed and still growing, served by the Tri-Energy uninterruptible supply and Energy Core. Path 2 is a mixed approach, validating in 2026 and deploying in 2027, using medium voltage storage and 800-volt direct current side, cars at the rack and pod level. Path 3 is a full data hall at 800 volts, still in development phase and deploying in 2028, built on solid-state transformers, which the company explicitly says are not yet scalable. And here's the moat: whichever path the client picks, Vertiv is on the field for all 3. That architecture agnosticism expands their content per megawatt, while removing the risk of betting on one technology path and being wrong. Our take is that this is the smartest structural position in the deck, because in a standards war, the toll collector, who serves every road, never has to pick a winner. Now the pipeline, and this page is about the shape of demand rather than its size. The company maps its pipeline on 2 axes: magnitude across hyperscalers, colocation providers, enterprises, and new cloud players, against speed, meaning sales cycle velocity. And the direction of travel is up and to the right on both, which means deals are getting bigger and closing faster at the same time. The supporting evidence they cite on this page starts with organic growth hitting 18%, with zero reliance on acquisitions. That word organic matters more than the percentage because bought growth and earned growth are different assets entirely. Second, a positive price-cost ratio expected for fiscal 2026, meaning they can raise prices faster than input costs rise. Third, capacity expansions actively coming online in Johor, the Americas, and Europe. Our read is that a company adding capacity while cycle velocity increases is a company that believes its own pipeline, and that combination is genuinely hard to fake. Alright, here's the controversy itself, and I want to be careful and fair about it. The deck names to causes flowing into one bottleneck. The first is first-time complexity, executing unprecedented mega projects they call Smart Run and One Core, which require massive coordination and rapid learning curves. The second is the one that made me sit up, and the deck labels it the self-own. Vertiv's own factories cross-supplying each other, with management confirming that the bottleneck was internal rather than any macro component shortage. Now here's the language fight. Management firmly rejected the word disruption and preferred the word congestion. I'll be honest with you, that word choice is doing a lot of lifting, and I'm not sure I fully buy it. To be fair, first-time mega project friction is genuinely logical and every company hits it. But the deck is right that the refusal to quantify the financial impact is what actually spooked the market. The company is guiding to a 45% growth ramp in the second half, which is a big ask after a delay, so let's see what's underneath it. The deck stacks it as 3 layers with a verification line drawn through the middle. At the base, verified backlog coverage, with deferred revenue mechanisms unchanged, so it's an apples-to-apples comparison rather than an accounting shift. Above that, verified capacity release, with known expansions in Malaysia, the Americas, and Europe coming online. Those 2 layers sit below the verification line, meaning you can check them from outside. Above the line sits the unverified piece, operational acceleration, which means conquering the learning curve on complex, mega projects, and that must be proven quarter by quarter. Management emphasized the concept of wiggle room built into this guidance 3 separate times during the call, explicitly assuming some congestion will persist. Our take is that saying wiggle room 3 times is either admirable conservatism or loading an excuse, and I genuinely can't tell which yet, so call it 50-50. Now let me do something I think matters more than any single number, grading how honestly they talked. On the honesty side, they admitted the bottleneck is internal supply, which is the least flattering possible explanation, and they gave it anyway. They volunteered, unprompted, that the European margin improvement of 380 basis points benefited from a low base effect the prior year. Nobody makes you disclose that your good number was partly easy comparison, and volunteering it buys real credibility with me. And they acknowledged similarities to last year's execution issues in Ireland, which means they're not pretending this is unprecedented. Now, the omissions. They refused to quantify the schedule delay in dollars, refused to provide exact progress, billing percentages, and omitted hard data on on-time delivery rates when directly challenged. The deck's synthesis is exactly right, honest about the nature of the problem and highly defensive about the numbers. Our read is that pattern usually means the number is embarrassing rather than catastrophic, and I put that at about 70%, but I'd rather be told than have to guess. This page is the strongest evidence in the entire deck, and it's easy to skim past. In Kaohsiung, Taiwan, the company points to a core partnership with Vision Bay, which is Foxconn and NVDA. That project is described as Taiwan's first NVDA GBay 300 AI data center, and critically, it houses what the deck calls the world's first 800-volt direct current architecture deployed at the rack and pod level, paired with NVDA's Vera Rubin platform. Remember path 2 from that agnosticism page, the mixed approach validating in 2026 and deploying in 2027. This is that exact path, physically installed with a named partner in a named city running a named chip platform. The company's takeaway is fair. The 800-volt transition is no longer a slide in a pitch deck. It is physically deploying. Our take is that this is the difference between a roadmap and a reference customer, and reference customers are what turn a technology claim into a sales cycle. Here's a smaller page with a bigger idea inside it than the page itself suggests. The product is called Purge Right Near Zero, and the company states it reduces startup water usage by up to 90% through closed-loop processing. That matters because data center water consumption is becoming a political flashpoint in a lot of communities, and a permit fight can kill a project faster than a cost overrun. Now, here's the part worth writing down. That technology is distributed exclusively through Vertiv's existing global service network, and the deck lands the point perfectly. Competitors can reverse engineer a cooling product, but they cannot reverse engineer a decades-old global service footprint. Think about your local plumber. Anybody can buy the same wrench, but the one who's been in your neighborhood for 30 years is the one you actually call. The moat has moved from product features to the distribution channel, and channel moats are slower to build and much slower to lose. Our read is that this page explains why the company survives competition even when a rival copies a product, and that's worth more than the water savings. Let's look at where the analysts spent their 17 questions, because attention is data. 6 questions went to the scheduled delay and the second half ramp, and the deck notes they were addressed qualitatively and left unquantified financially. 3 went to 800-volt direct current and content per megawatt, and those were answered positively with the roadmap validated. 3 went to deferred revenue and cash quality, also answered positively with the mechanisms confirmed apples to apples. So on 2 of the 3 topics, management had numbers and gave them freely. Then the deck lists 3 specific analyst requests that were bypassed entirely. The delay dollar amount, the progress billing percentage, and confirmation of high-end pricing per megawatt. Our take is that third one is the sleeper, because pricing per megawatt is the metric that tells you whether this boom is profitable or just busy, and declining to confirm it is a choice worth noting. This is the page that decides your position, and the deck refuses to pick a side, which I respect. On the growing pains side, a 24% organic growth rate, complex acquisition integrations combined with aggressive global capacity builds, and last year's Ireland execution issue successfully and fully resolved. That last point carries weight with me. A team that fixed the previous version of this problem has earned some benefit of the doubt. On the systemic flaw side, internal cross-supply friction is structural rather than external, meaning it's built into how they've organized themselves. The CEO admitted complexity will not disappear, which is honest and also unsettling. And there's no transparent on-time delivery data, so you cannot independently measure whether they're getting better. The synthesis is the correct one. A definitive answer relies entirely on the third quarter, and a repeat delay shifts this narrative permanently from the cost of hyper growth to a flawed operating model. Our take is that one quarter rarely settles a debate this cleanly, and this is one of the rare times it will. The company gives you a target with 4 rings, and I'd use it exactly as drawn. Dead center, priority 1. Does the third quarter hit the 3.75B revenue and 35% organic growth target? Hitting that proves the delay was merely a timing issue. Also at the center, priority 2. Do further schedule shifts occur? The deck calls that the ultimate fundamental test of the business model, and I agree. The middle ring, priority 3, operating margin holding near 24.55%, and deferred revenue growth matching actual revenue growth. That second half of priority 3 is the subtle one, because if deferred revenue grows faster than recognized revenue, work is piling up rather than shipping. The outer ring, priority 4, the solid-state transformer, research timeline and execution of unannounced acquisition deployments. 2 center ring items, both binary, both answered in 1 quarter. That's about as clean a decision point as this job ever gives you. Our read is you don't need to guess on this name, you need to wait 1 quarter, and there's no shame in waiting when the test is this well defined. Here's the scorecard, and the shape of it is what matters. Demand and pipeline solved and accelerating. Pricing power solved with a positive price-cost ratio. Technology roadmap solved with the Taiwan GB300 project physically deploying. Order backlog solved, growing and measured apples to apples. 4 out of 5 checked off, verifiable from outside the company. And then the 5th, operational execution, marked pending and unverifiable via guidance. The line underneath is the one I'd underline twice. Complexity is not disappearing, and management isn't promising the friction will end, only that they'll get better at managing it. Execution is the only variable that cannot be proven by financial guidance. It must be delivered. Our take is that a company with 4 solved variables and 1 open one is in a genuinely enviable position. And it's also the exact position where impatient investors get hurt. The closing page splits everything into what happened and what's promised, which is the discipline I wish more investors used. On the realized side, the facts: second quarter revenue of 3.27B, up 24%, operating margin of 22.6%, free cash flow of 920M, and a net cash balance sheet. Those 4 are done banked and cannot be taken back by a bad quarter. On the unrealized side, the estimates: the upgraded fiscal 2026 guidance, scaled 800-volt deployments in 2027, solid-state transformer viability, and Europe returning to organic growth in the second half. Every one of those is a forecast, and forecasts are where money gets lost. Alright, last thing, radar always leaves you a light. I'm calling this one yellow, and I want to be precise because this is not a yellow about the business. The business is excellent. Net cash, 150% cash conversion, 4 of 5 strategic variables solved, and the world's first 800-volt rack, level deployment already running in Kaohsiung. The yellow is entirely about one thing. Management declined 3 separate times to give a number that would let you size the execution problem. And the same team had a version of this problem last year. Here's what flips me to green. The third quarter landing at 3.75B with 35% organic growth and no new schedule shift. That's it. That's the whole test. Here's what turns it red: a second consecutive delay. Because at that point, congestion stops being a word choice and becomes the operating model. I'd rather wait 1 quarter and be late than pay up and find out. And if they nail it, I'll come back on this channel and say yellow cost me the entry. And I'm telling you that up front. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.